Question 1. Through the lens of financial management, Mr. Allen is reviewing his HVACR company's balance sheet and notices that current liabilities exceed current assets. He is concerned about the company's ability to meet short-term obligations. Which approach should he take to address this issue effectively? A. Increase long-term debt to cover short-term liabilities. B. Improve working capital by optimizing accounts receivable and inventory turnover. C. Immediately reduce all operating expenses to generate cash. D. Delay payment of all accounts payable until sufficient cash is available. Answer. Correct answer. B. Explanation. Improving working capital by managing accounts receivable efficiently, accelerating collections, and optimizing inventory levels increases liquidity without risking financial stability. Increasing long-term debt could worsen solvency ratios. Drastic expense reductions may harm operations and revenue generation. Delaying payables may damage vendor relationships and creditworthiness. Effective working capital management aligns with best practices for short-term financial health in HVACR operations, ensuring operational continuity and maintaining strong financial ratios, supporting sustainable business performance. Question 2. In the context of HVACR budgeting, Ramirez is planning next year's operational budget for multiple service teams. She wants to allocate resources accurately based on project costs, seasonal demand, and anticipated revenue fluctuations. What budgeting method should she use? A. Incremental budgeting, adjusting last year's figures by fixed percentage. B. Activity-based budgeting, linking costs to specific operational activities and drivers. C. Zero-based budgeting, assigning funds only after justifying every expense from scratch. D. Flexible budgeting, adjusting budget limits only after actual expenses are incurred. Answer. Correct answer. C. Explanation. Zero-based budgeting requires each expense to be justified, ensuring resources are allocated to activities that provide the greatest operational and financial benefit. Incremental budgeting assumes prior allocations are correct, potentially overlooking inefficiencies. Activity-based budgeting links costs to activities but may be complex and require extensive data. Flexible budgeting adjusts after the fact, which is reactive rather than proactive. For HVACR operations with variable seasonal demand and project-specific costs, zero-based budgeting allows managers to prioritize expenditures, align resources, strategic goals, and improve financial control. Question 3. Based on the information, Mr. Chen is evaluating whether to invest in a new HVACR service van fleet. He calculates projected cash inflows from additional service capacity versus the outflow for purchasing new vehicles. Which method best supports his capital budgeting decision? A. Payback period analysis to determine how quickly investment recovers. B. Net present value (NPV) calculation considering discounted cash flows. C. Counting rate of return based solely on book value of assets. D. Internal rate of return, assuming cash flows are reinvested at project rate. Answer. Correct answer. B. Explanation. Net present value accounts for the time value of money by discounting future cash flows against initial investment, providing a precise measure of investment profitability. Payback period ignores the value of cash flows beyond the recovery point and time value of money. Accounting rate of return relies on book values, not cash flows, providing a limited view of financial viability. O is useful but may give ambiguous results with non-standard cash flows. NPV aligns with best practices in HVACR capital budgeting by identifying projects that enhance long-term shareholder value and operational capacity efficiently. Question 4. Given the circumstances, Isa Patel notices her HVACR company is experiencing increasing overdue accounts receivable affecting cash flow. Which strategy is most effective for improving collections while maintaining customer relationships? A. Implement stricter credit terms and offer early payment discounts. B. Outsource all collections to a third-party agency immediately. C. Suspend services to clients with overdue accounts until payment is made. D. Apply late fees aggressively to all past due invoices. Answer. Correct answer. A. Explanation. Implementing stricter credit terms and incentivizing early payment encourages timely cash inflows while maintaining professional relationships. Immediate outsourcing or service suspension may harm customer loyalty and reputation. Aggressive late fees can lead to disputes and lost contracts. By strategically managing credit terms, HVACR companies balance liquidity needs with customer satisfaction. This approach aligns financial best practices, preserving cash flow without disrupting revenue streams, enabling sustainable growth, and reducing reliance on short-term borrowing. Question 5. From a practical standpoint, Mr. Davis wants to assess which HVACR service contracts are generating the most profit relative to labor and material costs. Which approach provides the most accurate insight? A. Calculating gross revenue for each contract without deducting costs. B. Performing job costing, assigning all direct and indirect costs to each project. C. Using standard costing based on average labor and material rates. D. Reviewing total company expenses and dividing by number of contracts. Answer. Correct answer. D. Explanation. Reviewing total expenses divided by the number of contracts gives an incomplete and misleading picture because it averages costs across projects and ignores variability in labor, materials, and overhead. Calculating gross revenue alone fails to consider costs. Standard costing may not reflect actual project complexity. Job costing accurately allocates both direct and indirect expenses to each contract, allowing managers to identify profitable and unprofitable jobs, optimize pricing, and make data-driven decisions about resource allocation. This aligns with HVACR financial best practices for operational profitability analysis. Question 6. Taking into account recent operational data, Johnson finds that her HVACR company's inventory turnover is significantly lower than industry standards. What is the most effective financial strategy to improve this ratio? A. Increase inventory levels to avoid stockouts and satisfy customer demand. B. Reduce slow-moving inventory through sales promotions or write-offs. C. Keep inventory constant and rely on delayed supplier shipments. D. Ignore turnover ratios as long as service performance is satisfactory. Answer. Correct answer. C. Explanation. Maintaining constant inventory and relying on delayed supplier shipments is risky as it may lead to shortages, delayed service, and dissatisfied clients. Increasing inventory worsens turnover ratios and ties up cash unnecessarily. Ignoring the ratio may mask inefficiencies. Reducing slow-moving inventory through proactive measures enhances liquidity, reduces holding costs, and improves operational efficiency. HVACR financial management. High inventory turnover ensures that capital is not tied in unused parts, aligns with industry best practices, and supports responsive service delivery, which is crucial for maintaining profitability in competitive markets. Question 7. Under the assumption that Mr. Thompson wants to evaluate the financial impact of expanding into a new HVACR service territory, which scenario analysis approach provides the most comprehensive insight? A. Only assessing the best case revenue scenario for the expansion. B. Developing multiple projections including best case, worst case, and most likely outcomes. C. Evaluating historical revenue trends without considering new market conditions. D. Focusing solely on fixed cost reduction opportunities in the current market. Answer. Correct answer. D. Explanation. Focusing solely on fixed cost reduction in the current market ignores potential revenue and risk implications of expansion. Assessing only the best case scenario creates an overly optimistic view. Historical trends may not reflect new market conditions. Developing multiple projections allows managers to understand risks, estimate potential returns, and prepare contingency plans. Scenario analysis is a core in HVACR financial management for strategic decision-making, ensuring investments are justified by considering variability in revenues, costs, and external factors while supporting long-term operational and financial sustainability. Question 8. When evaluating profitability, Lynn notices that HVACR branch has high gross margins but low net margins. What is the most probable underlying reason? A. High labor and overhead expenses are reducing net profitability. B. Underpricing services is directly affecting gross margins. C. Excessive inventory write-offs are affecting gross profit. D. Poor billing procedures are leading to lost revenue recognition. Answer. Correct answer. A. Explanation. High gross margins indicate services are priced above direct material costs, but low net margins often result from excessive indirect costs such as labor, administrative overhead, or operational inefficiencies. Underpricing with low gross margins, not gross margins being high. Inventory write-offs impact gross profit, not net margin exclusively. Billing issues affect revenue recognition but are not directly linked to net margin unless pervasive. Understanding the relationship between direct costs, overhead allocation, and profitability enables HVACR managers to control operating expenses, optimize resource allocation, and ensure sustainable financial performance. Question 9. In a modern context of HVACR financial management, Mr. Nguyen is analyzing data from multiple branches using accounting software. He wants to ensure decisions are based on accurate, up-to-date financial information. Which practice is most critical for achieving this goal? A. Performing manual reconciliations weekly while maintaining paper records. B. Integrating real-time data feeds from all branches into a centralized financial system. C. Using monthly summarized reports without cross-verification. D. Relying on individual branch managers' subjective assessments of performance. Answer. Correct answer. C. Explanation. Relying solely on monthly summaries without verification can lead to outdated or inaccurate information, risking poor financial decisions. Manual reconciliations are time-consuming and prone to error. Subjective assessments lack objectivity. Centralizing real-time data integration provides up-to-date visibility across branches, allows for timely identification of variances, ensures consistency, and strategic decision-making. In HVACR financial management, accurate and current financial information is crucial for monitoring performance, forecasting cash flow, evaluating investments, and maintaining operational efficiency, which directly impacts profitability and sustainability. Question 10. While examining HVACR service contracts, O'Connor realizes that several clients frequently request additional work outside the original scope. What is the most effective financial approach to handle these change orders? A. Absorb all extra work costs to maintain client satisfaction. B. Implement formal change order procedures with cost and timeline adjustments. C. Ignore additional work requests to prevent administrative overhead. D. Increase base contract prices to anticipate potential extra work. Answer. Correct answer. D. Explanation. Simply increasing base prices may overcharge clients for work they did not request and could reduce competitiveness. Absorbing extra costs reduces profitability. Ignoring change orders can damage client relationships and risk contractual disputes. Implementing formal procedures for change orders ensures costs, timelines, and responsibilities are clearly defined and billed appropriately. This approach aligns with best practices in HVACR contract management, maintaining profitability while preserving customer satisfaction, providing a controlled method to manage scope changes and ensuring accurate financial tracking and reporting. Question 11. Considering the evidence, Mr. Morales notices his HVACR company often underestimates project labor hours, leading to unexpected cost overruns. What financial practice should he implement to prevent this? A. Use historical job costing data to refine labor estimates for similar projects. B. Apply a fixed labor multiplier across all projects regardless of complexity. C. Ignore labor cost variability and focus only on materials. D. Outsource all projects to third-party contractors to shift responsibility. Answer. Correct answer. A. Explanation. Historical job costing provides empirical data for projecting labor hours accurately, reducing the likelihood of overruns. Applying a fixed multiplier ignores variability, which can create underestimates or inefficiencies. Ignoring labor costs overlooks the largest controllable expense in HVACR projects. Outsourcing shifts responsibility but may not reduce costs and can affect quality. Using performance to inform estimates aligns with industry best practices, allowing managers to plan budgets effectively, improve profitability, and maintain project timelines while supporting financial accountability. Question 12. From a practical standpoint, Simmons is evaluating whether to extend credit to a new commercial HVACR client. What analysis best supports? A financially sound decision. A. Reviewing the client's credit history, financial statements, and payment trends. B. Approving credit based solely on the client's verbal assurances. C. Offering unlimited credit to secure long-term business without risk assessment. D. Ignoring credit analysis and billing all services upfront. Answer. Correct answer. B. Explanation. Approving credit solely based on verbal assurances is highly risky and ignores objective financial data, increasing the likelihood of late payments or bad debts. Billing upfront avoids credit risk but may lose business. Unlimited credit without analysis exposes the company to significant financial risk. Proper credit evaluation through financial statements, trade references, and historical payment behavior. A balanced approach to minimize risk, ensure liquidity, and maintain client relationships. This method aligns with prudent financial management principles for HVACR operations. Question 13. Based on the information, Mr. Clark is preparing to evaluate whether purchasing a high-efficiency HVACR system for his business is financially justified. Which technique should he apply? A. Calculate the payback period and compare to the expected equipment lifespan. B. Examine only the upfront purchase price without considering operating savings. C. Focus exclusively on manufacturer rebates without calculating long-term savings. D. Ignore cost metrics and rely on peer recommendations. Answer. Correct answer. C. Explanation. Evaluating only manufacturer rebates neglects total cost of ownership, including operating costs, maintenance, and energy savings, providing an incomplete financial picture. Ignoring cost metrics and relying on peers is subjective and unreliable. Focusing solely on purchase price disregards long-term profitability. Calculating payback period in combination with expected lifespan and operate savings ensures a comprehensive financial evaluation, enabling HVACR managers to make data-driven decisions that maximize return on investment while considering both immediate and future financial impacts. Question 14. While analyzing her HVACR company's income statement, Ms. O'Brien notices disproportionate administrative expenses compared to revenue growth. What should she do to improve profitability? A. Perform detailed expense review and implement cost controls for overhead. B. Increase prices across all services without examining internal costs. C. Reduce field technician wages to balance administrative costs. D. Ignore administrative inefficiencies as long as gross margins are stable. Answer. Correct answer. D. Explanation. Ignoring administrative inefficiencies may maintain short-term gross margins but risks long-term profitability and operational sustainability. Raising prices without understanding cost drivers could reduce competitiveness. Reducing field technician wages may demotivate staff and harm service quality. Conducting a detailed review of administrative expenses, identifying inefficiencies, and implementing aligns with financial best practices, enabling HVACR managers to improve net margins, optimize overhead, and enhance sustainable profitability without sacrificing service quality or operational effectiveness. Question 15. Given the circumstances, Mr. Patel is comparing two HVACR service locations. One shows strong revenue growth but higher accounts receivable aging, while the other has moderate growth with minimal outstanding invoices. Which principle should guide his financial decision? A. Prioritize cash flow stability over aggressive revenue growth. B. Focus only on revenue growth without considering collections. C. Ignore differences in accounts receivable and evaluate only total sales. D. Consolidate operations regardless of financial performance metrics. Answer. Correct answer. A. Explanation. Cash flow stability ensures the company can meet short-term obligations, sustain operations, and invest strategically. Prioritizing revenue growth without considering collections may lead to liquidity issues and increased reliance on external financing. Ignoring accounts receivable masks potential financial risk. Consolidating operations without evaluation may reduce profitability. HVACR financial management emphasizes the importance of aligning revenue growth with effective collections and liquidity management to maintain operational continuity, reduce financial stress, and optimize long-term profitability and stability. Question 16. In a context of HVACR inventory management, is green notices a trend of slow move in high-value parts occupying significant storage space? Which strategy best addresses this issue? A. Implement just-in-time inventory to reduce holding costs and free up capital. B. Maintain the same stock levels to avoid potential stockouts. C. Purchase additional inventory to hedge against future demand. D. Ignore slow-moving parts as long as they are part of the catalog. Answer. Correct answer. C. Explanation. Purchasing additional inventory increases holding costs, ties up capital, and exacerbates slow-moving stock problems. Maintaining stock levels may continue inefficiencies. Ignoring inventory fails to optimize resources. Implementing a just-in-time approach minimizes holding costs, improves cash flow, and ensures parts are available when needed without excessive investment. In HVACR operations, efficient inventory management reduces financial burden, prevents obsolescence, and supports operational efficiency while maintaining service quality. This strategy aligns with best practices in modern supply chain and financial management. Question 17. Through careful analysis of historical projects, Mr. Rivera observes that certain HVACR service contracts consistently exceed budget due to unforeseen labor and equipment needs. Which financial technique helps mitigate future risks? A. Incorporate contingency reserves and risk-adjusted cost estimates into project budgets. B. Avoid bidding on complex contracts entirely. C. Assume all projects will perform as budgeted without adjustments. D. Transfer all costs to subcontractors without proper oversight. Answer. Correct answer. D. Explanation. Transferring all costs to subcontractors without monitoring creates risk of disputes, cost overruns, and quality issues. Ignoring potential variability leads to financial strain. Avoiding complex contracts may reduce revenue opportunities, including contingency reserves, and adjusting budgets based on historical variances allows accurate financial planning, provides a buffer for unexpected costs, and support management. HVACR financial managers must balance proactive risk mitigation with revenue generation, ensuring projects are profitable while maintaining service quality and contractual compliance. Question 18. When faced with declining profitability, Taylor notices her HVACR branch has high equipment downtime, leading to service delays and customer dissatisfaction. Which operational financial solution should she implement? A. Invest in preventive maintenance and equipment monitoring systems. B. Reduce labor hours to offset equipment repair costs. C. Ignore maintenance issues until equipment completely fails. D. Outsource all repair tasks without internal tracking. Answer. Correct answer. B. Explanation. Reducing labor hours may temporarily lower costs but often worsen service delays and profitability by reducing operational capacity. Ignoring equipment failures leads to unexpected repair costs and service disruptions. Outsourcing without oversight may result in high costs and lack of accountability. Investing in preventive maintenance and monitoring minimizes downtime, extends equipment life, reduces expenses, and ensures timely service delivery. In HVACR financial management, operational efficiency directly impacts profitability, and proactive maintenance aligns with best practices to optimize both performance and financial outcomes. Question 19. Under the assumption that Mr. Kim wants to evaluate pricing strategies for seasonal HVACR services, which approach ensures both competitiveness and profitability? A. Use cost-plus pricing considering direct costs and a profit margin. B. Apply uniform pricing throughout the year regardless of demand. C. Offer steep discounts indiscriminately to attract customers. D. Rely solely on competitor pricing without analyzing internal costs. Answer. Correct answer. C. Explanation. Indiscriminate steep discounts can erode margins and create unsustainable revenue patterns. Uniform pricing ignores fluctuations in demand and costs. Competitor-based pricing without internal cost analysis risks underpricing or overpricing services. Cost-plus pricing ensures all direct costs are covered while achieving target profitability. By accurately calculating costs and adding an appropriate HVACR managers can set prices that balance market competitiveness with financial sustainability, enabling predictable cash flow, improved profit margins, and strategic flexibility during peak and off-peak seasons. Question 20. As demonstrated by recent projects, Hernandez notices that inaccurate financial forecasts led to cash shortages and project delays. Which forecasting practice should she adopt to enhance reliability? A. Integrate both historical data and projected market trends into rolling cash flow forecasts. B. Base forecasts solely on last year's actual revenues and expenses. C. Forecast only on optimistic best case scenarios. D. Avoid forecasting and rely on ad hoc cash management. Answer. Correct answer. D. Explanation. Avoiding forecasting risks repeating previous issues with cash shortages, poor planning, and project delays. Using only historical data neglects changing market conditions. Optimistic-only scenarios provide an unrealistic view. Integrating historical data with projected trends into rolling cash flow forecasts allow HVACR managers to anticipate financial needs, align funding with operational demands, and reduce risk. This approach enhances decision-making, supports timely interventions, and ensures that both short-term liquidity and long-term project commitments are met, aligning with industry best practices in financial management. Question 21. In light of recent developments, Mr. Hughes notices that several HVACR service contracts consistently experience unexpected material cost increases. What financial approach should he implement to mitigate this risk? A. Incorporate material cost escalation clauses in contracts. B. Assume average historical costs for all projects without adjustment. C. Absorb extra costs internally to maintain customer satisfaction. D. Delay purchasing materials until the project is underway. Answer. Correct answer. A. Explanation, including material escalation clauses, transfers the risk of price volatility to the client, ensuring that unexpected increases do not erode profit margins. Using historical averages ignores market fluctuations and may underestimate costs. Absorbing costs internally reduces profitability and may compromise financial stability. Delaying purchases risks project delays, stock shortages, and revenue. Proactively managing contract terms with financial foresight aligns with best practices in HVACR financial management, ensuring cost recovery, maintaining service quality, and supporting predictable project cash flow. Question 22. To what extent does ISLI need to monitor her HVACR company's accounts payable turnover to maintain strong vendor relationships? A. Regularly review payment cycles to optimize cash flow without straining vendors. B. Pay all invoices immediately regardless of cash availability. C. Delay payments indefinitely to conserve cash. D. Ignore accounts payable metrics if current liabilities appear manageable. Answer. Correct answer. C. Explanation. Delaying payments indefinitely can damage vendor relationships, reduce creditworthiness, and increase costs through penalties or lost discounts. Paying immediately may strain cash reserves unnecessarily. Ignoring accounts payable metrics prevents timely identification of liquidity issues. Regularly monitoring payment cycles allows managers to balance cash conservation with vendor expectations, maintain favorable terms, support reliable supply chains. Effective management of accounts payable is crucial in HVACR financial management to ensure operational continuity, cost efficiency, and positive business relationships. Question 23. Illustrated by recent project trends, Mr. Walker is deciding whether to invest in automated scheduling and dispatch software for his HVACR service teams. Which evaluation method best assesses the financial impact? A. Conduct a cost-benefit analysis considering both productivity gains and software costs. B. Purchase the software immediately without a financial analysis. C. Base the decision solely on competitor adoption. D. Ignore software efficiency and continue manual scheduling. Answer. Correct answer. B. Explanation. Purchasing software without analysis ignores potential financial return and may lead to underutilization or unnecessary costs. Basing the decision solely on competitors lacks context for company-specific operations. Ignoring efficiency may continue resource waste. Conducting a thorough cost-benefit analysis compares investment costs to expected productivity improvements, labor savings, and potential revenue increases, providing a clear picture of financial viability. For HVACR companies, this aligns with prudent financial decision-making, ensuring investments enhance operational efficiency and long-term profitability while mitigating unnecessary expenditure. Question 24. When evaluating profitability, Brown notices high gross margins on HVACR installations but frequent project delays due to inadequate labor planning. Which principle should guide her corrective actions? A. Align labor planning with projected workloads to optimize efficiency and reduce costs. B. Ignore labor planning and focus solely on pricing adjustments. C. Reduce material quality to offset labor inefficiencies. D. Accept delays as unavoidable and maintain current scheduling practices. Answer. Correct answer. D. Explanation. Ignoring labor planning or accepting delays may lead to recurring operational inefficiencies, increased costs, and dissatisfied customers, which can erode net profitability despite high gross margins. Reducing material quality compromises service standards. Pricing adjustments alone cannot correct underlying inefficiencies. Aligning labor resources with workloads, scheduling effectively, and forecasting staffing needs. Projects are completed on time and within budget. This practice aligns with HVACR operational and financial management principles, maintaining profitability, customer satisfaction, and sustainable performance. Question 25. In the context of HVACR financial analysis, Mr. Singh observes a decline in current ratio despite stable revenues. What action is most consistent with good financial management? Increase short-term asset efficiency through faster receivable collection and inventory management. B. Take on additional long-term debt to improve liquidity ratios. C. Ignore ratios as long as net income remains positive. D. Reduce service offerings to limit operational exposure. Answer. Correct answer. C. Explanation. Ignoring ratios can mask liquidity issues and increase the risk of cash shortfalls despite positive net income. Additional long-term debt may increase financial risk and interest obligations. Reducing service offerings could limit revenue growth unnecessarily. Improving current asset efficiency through faster collections and inventory control directly strengthens liquidity, ensures the company can meet obligations and align HVACR financial best practices. Monitoring and managing key financial ratios enables proactive decision-making to maintain operational flexibility and sustain financial health. Question 26. From a practical standpoint, Carter notices that HVACR company frequently experiences budget variances due to inaccurate forecasting of seasonal service demand. Which approach best addresses this issue? A. Implement rolling forecasts updated regularly with real-time data. B. Rely exclusively on historical demand patterns without adjustment. C. Ignore budget variances if overall annual profit is positive. D. Apply fixed monthly budgets irrespective of seasonal fluctuations. Answer. Correct answer. D. Explanation. Fixed budgets ignore seasonal demand, leading to resource misallocation, missed revenue opportunities, or service delays. Relying only on historical patterns fails to account for market changes. Ignoring variances risks recurring inefficiencies. Rolling forecasts updated with current operational and market data provide flexibility and improve accuracy, allowing HVACR managers to allocate labor, materials, capital effectively. This approach enhances profitability, maintains service quality, and supports informed financial planning by integrating both historical performance and dynamic market trends. Question 27. Taking into account recent financial reports, Mr. Alvarez realizes his HVACR branch experiences high service contract cancellations due to perceived price unfairness. What financial strategy could improve customer retention while preserving profitability? A. Introduce tiered pricing models linked to service levels and value provided. B. Reduce all prices across the board to retain clients. C. Ignore pricing concerns as long as gross margins are adequate. D. Increase all prices indiscriminately to maximize revenue. Answer. Correct answer. A. Explanation. Tiered pricing aligns service value with customer expectations, enhancing satisfaction and retention without eroding profitability. Reducing all prices reduces margins unnecessarily and may signal poor value. Ignoring pricing risks continued cancellations and lost revenue. Increasing prices indiscriminately may drive customers away. Structuring pricing based on value and service levels reflects sound finance management, supports competitive positioning, and allow HVACR managers to maintain profitability while improving client loyalty and operational sustainability. Question 20. While analyzing capital expenditures is new and observes that older HVACR service vehicles incur higher maintenance costs and reduce operational efficiency. Which method is most appropriate for evaluating replacement decisions? A. Conduct a life cycle cost analysis including acquisition, maintenance, and operational efficiency. B. Replace vehicles solely based on age regardless of condition. C. Ignore maintenance trends as long as repairs are covered in the budget. D. Lease additional vehicles without analyzing total costs. Answer. Correct answer. B. Explanation. Replacing vehicles solely based on age may result in unnecessary capital expenditure as some assets could remain cost-effective. Ignoring maintenance trends ignores operational inefficiencies and higher costs. Leasing without total cost analysis may increase long-term financial burden. Life cycle cost analysis evaluates acquisition, maintenance, fuel, depreciation, and operational efficiency, providing comprehensive financial basis for decisions. In HVACR fleet management, this method ensures optimal utilization of resources, reduces unexpected costs, and enhances service reliability while supporting strategic capital allocation. Question 29. Under the assumption that Mr. White wants to analyze branch performance, he notices discrepancies between budgeted and actual labor costs across multiple HVACR locations. What should he do to improve accuracy? A. Implement standard labor costing methods and adjust based on actual productivity. B. Ignore differences since overall profits are on target. C. Reduce labor hours uniformly across all branches. D. Increase service prices without analyzing cost drivers. Answer. Correct answer. D. Explanation. Increasing prices without addressing underlying labor inefficiencies may maintain profitability short term but does not resolve operational issues. Ignoring discrepancies risks recurring overruns. Reducing hours uniformly may reduce productivity and customer satisfaction. Standard labor costing combined with adjustments based on actual productivity allows managers to identify inefficiencies, forecast budgets, and implement corrective measures. This practice ensures that HVACR financial performance is aligned with operational reality, optimizing both profitability and service quality while providing actionable insight for branch management. Question 30. From multiple perspectives, Ms. Rivera observes that slow invoice processing delays cash inflows for her HVACR company. Which approach best improves liquidity without harming customer relationships? A. Automate invoicing and implement clear payment terms with early payment incentives. B. Aggressively pursue late payments without negotiation. C. Delay invoice issuance to coincide with cash flow needs. D. Reduce service quality to compensate for delayed revenue. Answer. Correct answer. C. Explanation. Delaying invoice issuance can further exacerbate cash flow problems and does not solve inefficiencies. Aggressive collection risks client relationships. Reducing service quality is counterproductive. Automating invoicing and offering clear payment terms with early payment incentives improves liquidity, ensures timely cash inflows, and maintains customer satisfaction. This approach aligns with best practices in HVACR accounts receivable management, enabling accurate tracking, prompt collections, and a predictable cash cycle, which is critical for operational planning, debt servicing, and sustainable profitability.